Hi, everyone. Welcome to the week ahead. I'm Tony Nash. Today we have Tracy Schuchart, Bob Elliott, and Leo Nelson. We've got some really interesting key themes coming up. First is energy policies. Tracy's going to talk about how some energy policies have consequences in both the EU and US. It's very timely. Winter's coming on, all sorts of things, and we have some announcements around nuclear in the US. So I'd really like to dig into that a little bit. Bob has been talking about the Fed being over easy, and we're going to go into a little bit about what's happening there and what the next steps are given where we are in the economy in the US. And Leo's going to help us look at China's economic influence on Europe. So economics and politics, there's a lot of influence that China has on Europe, especially on EVs and tariffs and that sort of thing. So I want to talk through a little bit of that with Leo. So guys, thank you so much for taking time for our discussion today. I really appreciate it. Tracy, you are a woman in demand and you're headed to an event. And so please go ahead and promote it. Where are you speaking this weekend?
Yeah, so it's the Money Show and it's in Orlando at the Omni Hotel. So if anybody's in Orlando, you can stop by. There's a ton of speakers. Charles Payne is very involved with the Money Show, so he's at every event. But the speaker lineup is phenomenal. They've got workshops going on, they've got presentations going on. They've got, breakout rooms going on. So lots of fun investment stuff.
And this is Bob and Jim and all those guys. It
Yep.
just sounds like a great event. So if
I'll
you're in
be there.
Orlando this weekend, check Tracy out at the Money Show. So Tracy, you had a great tweet earlier this week related to European corporate earnings. And from your perspective, it seems like it has a lot to do with energy. So your tweet is this, it looks at corporate earnings and it says energy policies have consequences. So can you talk us through a little bit of that, a bit why energy policies are so impactful on earnings in Europe?
Well, if you think about it, right, what is one of your major costs as a business? Whether, and that, obviously it's incremental depending on what kind of industry you're in, but still energy is your major cost. You still have to keep the lights on. You still have to, it's a major input to all businesses. And even though we have seen energy prices come down in the EU, from that 2022 spike right after the Ukraine invasion, really their electricity costs have not come down at all. I mean, they're, three times what they are here, four or five, depending on what country you're living in. And so, that's caused a lot of problems with productivity, obviously, in the EU. And we're seeing that in, corporate earnings, just as we saw when we had that initial spike. We saw all the smelters come offline. They never came back, obviously, because
Where
once you
did they
shut,
go? Where did those smelters go?
no, nowhere. I mean,
Nowhere.
well, because once you shut down those blast furnaces, it's not like you can just light them up again. It takes months to get them up again. And energy costs have really not gone down enough. So we haven't seen a lot of those, come back. We have seen some move to Eastern Europe. But overall, we're still lacking a lot of capacity for some of those smelters that didn't come
Mhm.
back online.
So I have a friend who he was a chancellor of a university in Germany, and he's on a lot of corporate boards for German companies. And I asked him about this. I just spoke to him yesterday and I asked him about this. And we talked about nuclear in Europe. And I said, look, we've talked about the deindustrialization of Germany. You and Albert and Leo and I have talked about this for years. And I said, you had nuclear power plants in Germany. Is it coming back? He said, it's not coming back ever. He said, in Germany, the Greens have too much power. It's not coming back in Germany. He said, the irony in Germany is that we have no problem buying nuclear power when it's generated in France, but
Right.
we won't restart our nuclear power plants in Germany. So
Exactly.
what's your assessment? I mean, do you think the same? They're not ever going to come back to nuclear?
Well, I wouldn't say never. Let's see what happens within their government, but there have been studies shown that they can bring, it would probably take them about 9 months to bring those back online. And so it's definitely possible to do without building out a whole new facility. They absolutely could do it. Again, it's going to depend on how their government
Yep.
is going to shape up in the future. But it's ridiculous. We've talked about this before. They're burning more coal, they're burning more wood. I mean,
Yeah.
let's be
Back to
serious.
the 1860s or whatever, right?
They just had to build out, LNG regasification plants because they didn't have any of those, because they had piped gas, right, from Russia. And so they've been very unprepared for a very long time. And, shutting down nuclear plants was in the middle of an energy crisis,
Right.
was just mental.
Well, when I said to him, I said, look, even the Japanese have brought back some nuclear plants, and
Oh, yeah.
that was the basis of shutting down these plants. So it's hard for me to believe that Germany won't do this, but he said politically not possible. Leo, you're on the ground there, not in Germany, but in Europe. What are you hearing? What do you think they'll ever in Germany come back with a more sensible power generation policy?
Yes, I mean, as Tracy said, it all depends on the government. And I think right now there is definitely a shift in German politics. I wouldn't say, I mean, for example, if you look in North Rhine-Westphalia, which is one of the most powerful provinces in Germany, they still really like, the SPD, and even I think they have 15% that still votes for the Greens. So it's a very, very gradual shift, but I think they still have the infrastructure, and something has to happen. And as we will talk about, in the auto industry, we're really at the point where something needs to happen. And I think elections are next year. I mean, the Greens are going to look really bad. AfD will be strong, but that's not really. I mean, AfD is more like a vent where people can vent their anger. I don't think they were strong on economics. But then again, people are just now going back from the SPD to the CDU, which was Merkel's party, and Merkel's party started this whole process of exiting nuclear. So I always said, people are just going basically sheep, just from one party to the other, and in the end, it's still going downhill. But I think, to answer your question, there is a path to nuclear energy, but it will take at least a few years, and we really need to see a big political shift next year in the election. And right now, I don't see it, but we will see how bad things get in Europe, and if it gets bad enough, they'll be forced to change, and I think it will definitely happen. It's just not next year or in the next few years, but at some point it will. Within the next 10 years, if I had to guess.
Okay, so I'm going to ask this of you and Bob. Bob pretty much knows every country in the world, or every company in the world. So, I suspect that German companies, unions are big shareholders and power brokers in German companies. And so if we're seeing jobs kind of disappear because of this, when you shut down a smelter and move a chemical plant and all this other stuff, I would think at some point unions would get assertive and want to focus on this move back to nuclear, or at least more kind of economical power generation. Do you see that from a corporate perspective, where companies can be more assertive with politicians to get some movement there?
Me or Bob? What did you?
Why don't you go first, and then we'll.
Oh yeah, I mean, it's tricky because these unions have been pushing really hard for extremely high wage growth, especially in automotive and chemicals, and that's going to really hurt because they are now laying off people. Volkswagen, I think for the first time in 30 years, canceled job guarantees. And these people, I remember when I was 14, 15, people always said, these guys in the automotive industry, which is like 15 years ago, they make a lot of money. And it was true, they got big bonuses, even in some of the weaker years. And it was a great place for Germans to be in, just working on cars and across the entire supply chain. And now that is, shifting. They're not only Volkswagen, but others are closing plants as well. And I think Germans, all the German car industry companies combined have like 40 plants in China, which is more than in the home country. So there is this shift, and unions will need to see that something needs to change, and that starts with wages. But wages is just one part. It's energy, as Tracy said, energy is the biggest part of cost. So it's all political. Unions really need to wake up and see, okay, wage growth is one thing, but that's now eroding because we will lose jobs down the road. So I think they will need to get way more political if they really want to make an impact for their workers.
Yeah, Bob, what do you think about that?
Well, I think the from the corporate perspective, we're seeing a lot of those companies realize that you want to have your supply chains where your end demand is. And so, there has been a meaningful hollowing out of, the ability to produce domestically in places like Germany, given the challenges that they're facing. But, so those car companies are producing in South Carolina and other places in the U.S. And as Leo noted, have large facilities in China producing domestically. And so I think part of the story here from macroeconomic standpoint is Germany in particular is getting squeezed from a couple of different directions. And at the same time, it doesn't matter, which I know is a bit of a bold thing to say, but even in the European context, Germany is, many people will point to Germany and say, well, Germany is slowing down, is experiencing very weak economic conditions, and, challenging employment conditions and things like that. But when you look at the Eurozone bloc as a whole, what you see is actually, unemployment is at, secular lows. And that's because places, stronger growth in the South, is overwhelming the weakness in Germany. And so I think actually one of the challenges that's going on right now is that Germany's feeling the pain, but also doesn't matter enough to drag down, the rest of Europe.
I'll be honest, that's pretty stunning to hear that Germany doesn't matter. I mean, I think it's a great assessment, but I think given the traditional role that Germany has had economically, politically, financially. And, I assume that maybe part of that is these kind of middle-sized companies where the leadership is retiring and they're selling to somebody or they're closing. So are we seeing that? Because I know that Singapore and China and Taiwan and other places had this strategy of buying those middle-income companies and basically hollowing them out, or not middle-income, middle-sized companies, and hollowing them out and moving them to Asia. Has that been successful as far as you can tell? And has that been a component of Germany's kind of lack of, say, the fact that they matter or not?
Yeah, I mean, I think it really comes. I mean, the international companies have obviously diversified a lot, like relative to 20 years ago. These are internationally producing companies. They're not, the odds that you walk onto the lot in the United States and buy a car with a German company car that was meaningfully produced in Germany is essentially zero, unless you're buying like the really expensive ones, right? If you're buying any sort of line car, it's produced in Mexico, it's produced in the U.S. South, it's produced, it's basically, it's not a German car.
Right.
It's a German company's car, not a German
brand.
It's a German brand, exactly. And so I think that story, has is the big story of what's going on. And lots of different ways in which the intellectual property has been sort of taken out of Germany, so it doesn't matter so much, as well as the manufacturing capacity. So there really is a problem. There's a challenging problem there. It'll be, it's interesting. If we go back 10 years ago, the real question was, would the strong Germans support the profligate South that was feeling pains of a debt problem?
Yeah.
In many ways, the next 10 years of Europe might look the exact opposite, which is how will the South respond to a Germany that is struggling and, to some extent shooting themselves in the foot by not, by pursuing an energy policy that is, let's say, putting, philosophy or social good ahead of economic good.
Yep.
And, how will people accept that?
And who would have known that the Russia-Ukraine war would have resulted in a weaker Germany? I mean, complete unintended consequences, right? but here we are. So, and all of this goes back to energy. So, and again, Tracy's been talking about this for years. So, Tracy, I want to switch a little bit, and I'd like to talk about U.S. energy policy. So, I'm sitting in Texas, where I pay less than $3 a gallon for gasoline. We pay 14 cents for electricity. You know, companies are moving here, and despite Texas being a cultural desert where the best bagels you can get are from Costco, and there's snakes and scorpions, and we have terrible beaches, you know, we still have people coming here. I still want to insist that Florida is a much better place for companies to go.
We're
But
sort of full.
yeah,
We've
okay,
got alligators, you don't want to,
right.
got
Alligators
lizards,
and
you don't
hurricanes,
want lizards, we got hurricanes,
but beautiful beaches, right?
you don't want to come here.
Right. So we've talked about nuclear a bit, and we saw Microsoft a couple weeks ago announce nuclear power for its data centers. Now we're seeing Google and others do this, and you talked about the Google Kairos deal for SMRs. So, you know,
We've had a couple of really
Yep.
big deals lately. In September and October, we had Microsoft starting wants to restart 3 Mile Island. We have Oracle is designing a data center that's going to be powered by 3 small nuclear reactors. And then we have the Google Kairos deal.
right. And what's really interesting is we mock policymakers here a lot, and the US Department of Energy, Secretary, and all this other stuff, we mock those guys a lot. And what's interesting to see here is despite really bad policy at a federal government level, you have companies who are coming in and, you know, deploying these SMRs and starting these nuclear power plants. So it's weird. It's a kind of a weird bright spot in terms of the US energy regulatory environment. So are there hugely problematic areas that could inhibit growth like we're seeing in Europe? So what's the blind spot for US energy policy that companies aren't seeing? So are we going to see things like some sort of policy come up that people aren't aware of where you can't grow, say, AI data centers, that sort of thing?
You know, I don't think so. And, you know, everything, you know, even though we have a federal agency in charge, how you said, you know, it's very different from Europe that it's not national owned. You know, we don't have a national utility company. We don't have, right? And so these companies, you know, can pursue what they want to do in nuclear. And I think a lot of this has to do with, you know, our grid infrastructure really needs updating if we're going to handle all of this. Now, how long is it going to take the federal government to, you know, step in and have an infrastructure project on this? Likely that it's not popular with voters. So we really haven't seen, you know, we've haven't the infrastructure bill that the inflation bill, sorry, which, you know, had a lot of money going into certain projects, but nothing towards the grid. It's for some reason it's just not popular with voters, and so we can't get that through. And so I think these companies are looking at that and saying, well, how can I kind of bypass all of this? And nuclear is the best way to go. And particularly if you're talking about small modular reactors. Now, Russia and China are the only ones that actually have these up and running already. The United States does not. But we're very close. And, you know, you also have Rolls-Royce in the UK that is working on that. You have NuScale in the United States that's working on that. And so these things are getting very close. And I think it'll take a little bit of time for them to get more and more affordable, because right now the prices you're looking at are still kind of out of range, but
yeah, but nothing's affordable.
But well, that's true. But at least we're going there, and at least we're pursuing that. And you know, we even saw some data companies just recently were looking to actually direct a pipeline for natural gas to power their nuclear plants, therefore bypassing the utility companies.
Yeah.
And so I think you're going to see a lot more creativity as far as, because, you know, they're not going to let, you know, infrastructure or the federal government, I think, stop them, right?
Yeah.
They're going to get very creative in the way that they handle how they can get their power.
So interesting when you talk about direct to pipeline, when about 10, 15 years ago, when a lot of the financial services companies in New York, New Jersey had to move their data centers to Texas, some of them built their data centers right on a pipeline so they could get direct natural gas to their data centers so they didn't have to worry about blackouts or other things from Texas utilities. And so, it's interesting to see the actual data center companies come with their, not just natural gas, but their own power generation. It's fascinating to see. And it's one of the things I like about the US is you can circumvent the government if you have enough money, right? And so that's what these guys are doing. The one thing that it gives me a little bit of thought about is this. Going back to what we talked about as Germany, in Germany, we will probably never see an AI data center in Germany given the price of power. Is that a fair assumption to make?
Well, I always say never, but yeah, I don't think you're not, your ideal place to set up a data center is not going to be in Germany.
No, it's going to be France, right? I mean, given all the nuclear power they have, France has a massive opportunity for data centers now.
Yeah, absolutely.
So, okay, very interesting. Tracy, what am I missing? And before you go, I know you've got to head out for this event. What am I missing on energy from this week?
So I think that's good. I think the only other announcement did come that the US opened applications for $900 million for small nuclear reactor, which means you can get domestic funding for those if you meet certain criteria.
Great. Very good. Okay, Tracy, thank you. I know you need to go. Thank you so much.
Thanks,
Good luck at your
guys.
event. Have a great weekend.
Okay. Cheers.
Thanks. Okay, and so Bob, let's move over to you. You're one of the most thoughtful guys on macro, and I'm so grateful that we have you on. And about a month ago, you tweeted about the desire of every asset manager and executive for an aggressive easing cycle. But the pain that folks on Main Street are feeling is around inflation still. And by inflation, what I'm talking about is not necessarily the rate of inflation, but say the pricing levels. So we have, say, the capital holders, the asset managers and executives who want an easing cycle. We have consumers who kind of don't because of inflation. I've been thinking about this since you sent it out, and this may sound kind of like a naive question, but I'm honestly curious, why is there such a disconnect between these financial titans and normal Americans?
Well, I think the desire from the financial titans is pretty straightforward, which is that financial titans always want easy money. I mean, unless inflation was so extreme in terms of that it would be meaningfully destabilizing, which we're not. Even the elevated inflation that we saw, a couple of years ago was not even at that level. And so the titans of Wall Street and the coastal elites are essentially always incentivized to argue for easier monetary policy than is appropriate given economic conditions. And I think what we've seen in terms of this push for an aggressive easing cycle has been largely in line with that general, I'd say, set of incentives that's going on. And so I think what you're seeing is they're arguing their book, both directly and indirectly in all sorts of different ways. And that, in many ways, Main Street is arguing, so to speak, its book, which is, what is the big pain that the everyday American sees? It's not employment on a day-to-day basis. The median household in America is employed, right? Labor force prime age labor force participation is basically at multi-decade highs. So, people are working, and their wages are going up pretty well, 4 or 5% a year on a per employee basis. I think the main challenge is that they see prices going up. And so, of course, that's the issue that hits in the forefront of their mind, right? It's not a problem they're employed. It's not a problem their wages going up. The problem is the prices are going up. And so until that gets resolved in a way that, they don't see it on an everyday basis, then, that's they're going to continue to say that is the primary Main Street problem. I think what they have a hard time doing on Main Street is balancing, well, what is the cost of, what could plausibly be the cost of bringing down that inflation? They're not, when you ask them that question, they're not thinking, okay, well, how do you balance these? And, how much unemployment would you take? And how much of a risk of losing your job would you take in order to bring prices down? So, it is a little bit an unqualified answer, so to speak, when
Sure.
you're thinking about how they're responding.
So you're telling me, so when I watch college football on Saturdays and I see the ad for the Arby's value meal, you're telling me that that's not enough. That's not going to help your average everyday consumer to feel
I don't think so.
Good.
I don't think the Arby's value menu or the McDonald's or Wendy's value menus are quite good enough.
Right.
I think people are seeing it all over. And I think that, here's the basic challenge is that we live in a services economy. Obviously we need to eat, and, we consume some share of our consumption as goods, but the big picture is we live in a services economy. And so, basically with and what prices services is wages. And so if wages are growing at 5% and people's spending is growing at 5%, it then means that, necessarily wages, essentially prices are growing at 5%. Like those things connect to each other.
Right.
And that sort of cycle, which isn't really a spiral. People often talk about wage price spirals. It's not a spiral. Think about it just more like if, my nominal income goes up 5% and my nominal spending goes up 5%, then, that's got to go to somebody who is producing that good. And, if their productivity isn't growing at 5%, then the difference between my nominal spending and the productivity growth is essentially what price growth is. And so, the fact that we have elevated services in wage pressures means we have elevated services inflation. And that is the big deal thing for people in all sorts of the different ways in which they live their lives.
Do you think consumers would want just a little bit of deflation?
Well, I think they'd love deflation if it didn't cost them any wage growth. And I think that is, that's the challenge. I think, as a simple example, people are pretty happy that used car prices are going down. That's a good thing. Or oil prices are going down, right? That's essentially those sorts of things. In a lot of ways, I think this is the basic challenge from the Fed's perspective is oil prices have come down a lot, $5 to $3, even less than that, depending on where you're living. That puts money in the pocket of the consumer. Now that if they take that money and they just spend it on more services, right, then actually that's stimulative and that's actually, worse for inflation, essentially by squeezing labor markets that are already tight to get that incremental services demand to be met. And so it's not like there's no easy answer. Like the problem is in the arithmetic in the sense of if your nominal wage growth is at 5% per worker, then and productivity growth isn't at 5% per worker, it's meaningfully less than that, then you can get some maybe measured inflation starts to move around this way or that way or the other way. But like the big picture story is inflation is still too high because nominal spending is too high. And so the question is, do you take the pain to reduce nominal incomes, which will reduce nominal spending, which will reduce inflation, or do you not accept that pain? And basically what the Fed said is, we don't want to accept that pain.
They don't.
They just said, we appreciate that inflation is above our mandate, and we're not going to accept the pain. And so, we're whether, and we believe that inflation will be beat somehow, some way, and so let's start easing.
We know how to
that's-
be beat, right? It'll be beat with some financial downside. I mean, that's ultimately how all of these things get beat.
Right, exactly. Like the path to having inflation come down to the Fed's mandate is relatively straightforward, which is that you're going to have asset prices fall.
Mhm.
Likely, if the Fed is not tightening, it would probably come from a market-based tightening, meaning long-term interest rates rise, which creates a hit to financial asset prices, houses and stocks, which then creates a shift towards higher savings relative to spending, which
Yep.
creates an economic slowdown, and that then starts to reduce the pressures on inflation. That's the way it works. But if anything, we're kind of moving in the opposite direction. At least on the short end, we're moving in the opposite direction, where the Fed looks at this set of circumstances and says, let's cut and run essentially over easy monetary policy in the context of the current economic conditions.
Okay, so in your thread, you mentioned that an independent central bank is key. But outside of theory, is it really possible to have an independent central bank? And I don't mean that to sound too sarcastic or, too mean-spirited. So when I was with The Economist, I was talking with one of our kind of old economists at one point, and I was even cynical back then. And he said, look, if you're going to evaluate an economy, you have to trust the central banker. And if you don't trust the central banker, then that really destroys a lot of the foundations of your economic analysis. So, we're kind of in a weird position where everyone is a, armchair economist, and everyone suspects the Fed and all this other stuff. So, and the ECB and, other central banks. So is it possible to have an independent central bank in reality?
I think the answer is yes, and I think mostly we have independent central banks. And when I say that, what I mean is that the Fed governor is not the decision making by the Fed governor is not being meaningfully influenced by those people, by politically or elected officials. That's what I say, not meaningfully influenced. So as an example, like Elizabeth Warren can write all of the documents and memos that she wants, and from what I hear, Chairman Powell has a particular favorite filing cabinet for those memos, which sits in a small basket underneath his desk, right? And so that's, and doesn't care about it. Right? She can say whatever she wants. It doesn't make it is not influencing policy.
Right.
And so I think that is, when you talk about what is an independent central bank, I think that is a reflection of the independence of a central bank.
Right.
And so, and I have not seen meaningful evidence to the contrary that the way in which the ECB or the Bank of England or the Fed or the RBA is operating is inconsistent with that view, that they're operating with their own decision making. I think people get confused that we might disagree with the way with the decisions that they are making. Right. But and I certainly, what I'd say is, I would say that Chairman Powell easing aggressively, choosing to ease aggressively while acknowledging the economy is strong and inflation is above their mandate is unorthodox and, likely imprudent. I don't believe it's there's nothing that looks like it's a function of outside political influence. It looks like it's a function of, I'd say, a disagreement about a view of what is likely to transpire. A disagreement about, one, the view of how tight current monetary policy is, which, reasonable people could disagree about.
Yep.
And two, what is likely needed in order to achieve a durable move of inflation down to 2%, where, he thinks monetary policy is very restrictive. I don't. And, different people can see that differently. And where he thinks that measured inflation is going to go down to 2% ahead, And I see a lot more risks related to that ahead. And so, those are just disagreements about how we see the world playing out, which doesn't mean that it's politically influenced. It just means that you can have disagreement about the macroeconomic dynamics.
So we're not the PBOC yet.
Yeah, I mean, um, I don't think so. I think actually one of the challenges that the PBOC is really having, I was just talking to someone recently, like the difference between Yi and Pan is like, it's like night and day. Like you have a Western trained, PhD from a top Big Ten school economics department, who's published, dozens of papers in Western journals. And you have a person who went to like a 500th ranked school in the world that, has never worked in a Western environment, never published in such an environment. Like, you couldn't get any worse. I mean, those are just, that's like kind of on paper. And if you even just hear the two parties talk, it's just night and day in terms of the quality and the skill and the thoughtfulness.
The credibility of Chinese economic announcements has deteriorated so much. It's unbelievable.
Exactly. And I think they're facing, it's not even like it's not even like political influence. It's when you replace highly skilled technocrats with political hacks, you get incompetence. That's the way it works. And that's exactly what we're seeing is incompetence.
Yep. It's not a command economy, it's a demand economy. That's what it's turning into, right? You a few days ago you posted this tweet about rate cuts, and it looks like rate cuts are expected for every meeting over the next 6 months. So why do you say things are over easy, and what alternative actions do you see for inflation and the monetary policy challenges? Sorry.
Well, I think if you just take a step back and say I put you in a somewhat random economy, developed economy, and I said, here's the basic circumstance. Inflation has been, over the target for a few years now and remains modestly above target. Growth is running at 3%, which is at or above potential. And the unemployment rate is, basically at 40-year lows, or just above 40-year lows. What would be and interest rates have basically been the same for the last 2 years, 2 or 3 years. What would be your answer to the question of what's the next step of monetary policy? Like, my guess would be nothing. At a minimum, I'd probably say flat.
It's okay to do nothing.
And it's okay to do nothing.
Yep.
Given that set of circumstances, that would be sort of the orthodox monetary policy response. That's not what the Fed is doing. And in particular, the motivation, I think, is really important. Like what really drew my thought to, let's call it the over easy path, that drew my sort of understanding that they're pursuing an over easy path was Chairman Powell in that press conference. He could have said, hey, I think the labor market's deteriorating rapidly. I think this is a real concern. We need to get ahead of this. We need to really make sure that we're easing monetary policy quickly because, things could get very bad very quickly. That would be that wouldn't reflect a change in the reaction function of the Fed. It would reflect them predicting a certain outcome, but their behavior of saying that they're going to cut relatively aggressively would be consistent with their past reaction function. What he said was very, very different, which is the economy is strong and I'm going to cut, and I'm going to cut a lot. That is a totally different set of circumstances, because what that's saying is that despite the fact that the macroeconomic environment and data would suggest, essentially a do-nothing policy, he's making the choice to cut relatively aggressively and bring net accommodation to this current economic circumstance rather than, maintain the current policy level. And I think that is, that's when you talk about over easy, that is over easy policy. Like when you have a hot economy and you're choosing an accommodative path, that is, that's over easy policy. And we've seen that plenty of times in history. It's unorthodox, but not uncommon. And, it has macroeconomic implications and market implications, frankly, that we've seen a fair amount of over the course of the last couple of weeks.
it's an easier, softer path. And people love it while it's happening, but music stops at some point. So when we look at markets in this environment, so I think we've had some head fakes on things like tech, right? Where tech peaked in July and a sector rotation started, and now we see like Amazon's up 1% today and Meta's up 1%, all this. So we're seeing tech come back because people are looking at the over easy policy and they're saying, well, maybe we should stay in tech a little bit longer, right? So as you look at this and as you look into, say, the end of the year or early 25, how are you playing this? I mean, are you just kind of letting it run as long as it can, or are you taking some defensive positions to prepare? How are you looking at markets and your positioning right now?
Yeah, I think, as I said, over easy monetary policy, if you look back through time, is it's not common, but it is certainly it certainly has happened. And I think, the basic story when you when an economy is hot and you run easy monetary policy into that economy, you basically get market action that should be supportive to gold in your currency and
Right.
stocks, and it should be detrimental to bonds, and particularly the long end of the bond market, and create a yield curve steepening.
Which is what we've
And
seen, right?
I mean, essentially, that's what I wrote when the Fed made their announcement. I said we're likely to see that ahead, and that's basically what we've seen over the course of the last couple of weeks. Today gold's pressing to new highs. Bond yields have moved up pretty considerably actually over the course of the last couple of weeks, and stocks are hanging in there. And so I think that is I think the challenge with this sort of environment is basically like, as long as over easy monetary policy is the path being pursued, the momentum of the markets in these directions can actually run, far outpace exactly what's happening with earnings or exactly what's happening with growth. I think it comes to an end when you get enough of an interest rate rise that starts to call into question whether growth can be as strong in the future, or whether asset prices, particularly stocks, can be as strong on a level basis. But that's probably, I'd say a lot of the easy money has been made in this trade, which is good. Don't get too greedy on these things. A lot of the easy money's been made, but there's probably, we probably need bond yields in the 4.5 to 5 range before it's really going to start creating concerns in the economy. And, we're not there yet.
Yeah.
And so, you could easily see an environment where it continues to run, that far.
So are we at the point of the cycle where you would say, hey, this is kind of where I would look, but you kind of have to stay pretty nimble because you don't know when it could change? I mean, is that kind of?
I think that's right, is that this sort of macro trend environment, it's the trend until the markets essentially move sufficiently to start creating the reversal in that trend, which is a little bit what we saw at the end of last summer, right before the Fed and Treasury eased. Interest rates had risen to a point where people were starting to call into question, stocks had started to fall, interest rates were at 5%. That combination people looked at and sort of said, that's probably like a little too tight. And we're probably, that for what's going on with conditions. And so I could envision us getting into that sort of world where, interest rates rise enough and stocks start to get a little skittish, and maybe earnings are a little bit softer, and, that combination of things. And that would really mark the turn. So the main thing here is not to get too greedy, like run the trend. It's, the over easy trend, but, as it goes in your favor, you should be taking money off the table rather than doubling down on it.
Yep, that's really solid, really sound advice. Bob, thank you so much for that. Let's move on to Europe. And Leo, obviously you're based in Europe, and you watch European markets very closely in addition to energy and everything. So I know some of you are aware of Leo. Leo has been on the show several times. He publishes very often. If you don't follow him on social media, please do. Someone told me he's the most reliable. What did they say yesterday, Leo? You're the most reliable person who's made money for them on Twitter.
Yeah, I think it's something about stock picks being very reliable. I don't know if it's true. I mean, I don't really know what others are up to, but looking at my portfolio, I really can't complain. But
It's
it's
okay
not.
to brag.
I don't know, I'm not some hedge fund guy. So, but I'm doing all right. Yeah.
Take the win. Take
Yeah,
the
take
win,
the win.
man.
Yeah.
It's okay to brag. Exactly.
That's the problem. That's why Leo doesn't have more followers, because if one of them big accounts was doing well on their stock picks, they'd certainly let you know.
Yeah,
Absolutely.
that's true.
That's true. So we're gonna let you brag as much as you want in this segment. We're gonna promote you a little bit more. So, China's strategy to flood global markets with competitively priced EVs has already secured a significant foothold in Europe. You're seeing, evidently, I haven't been there, but evidently there's a lot of Chinese EVs on the road in Europe. That puts pressure on European industries. We already talked about the auto sector. We've seen a lot in recent months about the EU raising tariffs on EVs from China. And China's exploring retaliatory trade actions, of course. This is just the cycle, right? To counter those new tariffs. European brands have done extremely well in China. You mentioned Volkswagen, BMW, Porsche. We've had a lot of
yes.
European brands who've done extremely well in China. But what's the sentiment in Europe for Chinese cars? Is Europe completely open to this, and Europeans are happy to buy Chinese cars, or is it kind of a forced, say, budget type of decision?
I mean, it's a very interesting development, and I mean, I would say even a little bit scary for Europe, because we still rely. I mean, when Bob said that Germany is increasingly unimportant, I mean, it's true, but if this continues, then we could see some cracks in other countries as well because of these connected supply chains. But if you look at the situation, I mean, before the pandemic, 2019, German car companies, the big guys, they own like a quarter of the Chinese car market, which is, I mean, fantastic for them. I mean, it's the fastest growing car industry in the world, and you have a quarter of it, which is, I mean, absolutely fantastic for them. And it made a lot of sense for them to invest in China, because Europe is declining. Car unit, even if it's EV or whatever, it's coming down, because people, the way cities are structured, governments, they just want fewer cars on the roads.
Mm-hmm.
And in the US, it's also very saturated, and it's hard to build, because Toyota is very big in the budget segment. Not necessarily budget, but just reliable everyday car. You obviously have, if you want a lot of horsepower, you can buy a Ford Mustang or whatever. They're way cheaper than the Germans. And Germans always stood out when it came to luxury and just the interior quality and build quality. It was great. They weren't as reliable as the Japanese, but German cars were always, a symbol of status, of wealth, and even for people, middle income people who could buy entry Mercedes and BMWs and whatnot. But that is changing. If you look at China, Chinese people really like the domestic car companies, because it's all about tech to them. If you on Twitter, sometimes you see some of these videos where they present new cars, and I don't know what the brand was, but it was really it really looked like a Porsche Panamera or whatever. But it was filled with tech, and even some of these cars, when you get in, it really says hi, and it knows your name and everything. I don't think it's needed in Europe, but Chinese people really like it. And I just had this chart. You can combine this technology with EVs really easy. I mean, Tesla has done it. Their interior is just one screen, and you have your self-driving stuff and whatnot. And then Chinese, the EV, 2019 they sold like 5% of the cars were EVs. Now it's way above 20. And during this period, the market share of these Germans went down from 25% to 15%, which is not a huge deal. And when you look at what these people care about, they want tech, and they want it to be very affordable. And there is no way Germans can compete with Chinese car companies, because they also own the supply chain of these rare earths and everything needed for these batteries. So let me look up this chart, which is quite interesting. When they looked at what are the most high-tech car companies, right? And number one was Tesla, followed by NIO, which is Chinese, XPeng, Rivian, from the US, Lucid, also from the US, Geely, Chinese, and then BYD, which is the fastest growing EV company anywhere in the world. And then the Germans, BMW, Mercedes, Volkswagen. So they really lag behind. And Germans want to stay in China. So when you talk about tariffs, they didn't want Germany to make the case for higher tariffs. because they still need this market. I think they know that they are losing. I mean, that's very common in news. Everyone knows it, but they don't communicate it. But they still need this market. I mean, what else are they going to do? Push hard in the US? That's going to cost a lot of money. In Europe, that's, I wouldn't say a lost cause, but it's really expensive for them to try to somehow expand and squeeze this lemon in Europe, especially because Europeans, and that was what you asked me, are really warming up to Chinese cars. And I didn't expect it, but yesterday, or the day before yesterday, the German AAA, which is ADAC, they published a survey where they asked Germans what they think of Chinese car companies, and 60% of them considered buying a Chinese car at some point, and which is a lot because right now the market
60%.
share of Chinese,
Whoa.
sorry,
60%.
60% would be open to buying a Chinese car in the next few years.
Wow.
Yes, 60%, and which is interesting because right now the market share is below 2% of Chinese car companies. There are some on the road, but not that many. And just like the Chinese, the Germans care about is cheaper and it's filled with technology. So that's not at all what the Germans always, prestige and everything. So that's a big problem for them. And I also get the feeling that, the government, I mean, I think they care, but not enough. For example, when you are in Germany, and last year when I went to a few Christmas markets, municipalities used these big vans to, as protection against peaceful immigrants. They cannot slam their cars into the crowd. And almost all of these cars that I saw, even in major cities, were Chinese built. Now, I couldn't recognize the logo. I think it was Build Your Dreams. But these municipalities, they buy them a lot. And even in the Netherlands, where I live, a lot of these municipalities buy these Chinese vans. And that's quite interesting because, if you want to have, support your own economy, you shouldn't buy these car companies because they own their own supply chains in China and even now try to push into Europe and build their cars over here. So overall, I think the bull market for the Chinese in terms of sales in Europe is far from over. It looks quite good for them.
Interesting.
Especially in terms of inflation, they can build so much cheaper. Their technology is quite good. And compared to, the other stuff that they sell, like cheap electronics, their cars are quite good. I'm personally not interested in these Chinese cars because it's too much tech. And I really like, this German or even the Japanese reliability, but others don't. And I think that's why China will keep growing, and that's going to be a big problem in the next few years.
That's it's super interesting. Can you send me those charts, by the way? Because I'd love to put them up on the screen when we talk about it. But that 60% number is huge. I had no idea. I can't imagine anywhere in the US that would say 60% of Americans would consider purchasing a Chinese car. We don't have the prevalence of cars of Chinese cars in the US that you have in Europe.
And we don't even try. And when I say we, I mean Europeans. But when you look, we have French cars like Citroën or Renault, and they don't even try to sell in the US because there's no point. For the German luxury cars, it's much easier because it's status and people with money like these cars, and it makes sense to grow. And AMG for Mercedes, it's much easier for them to grow in the US, but they need volumes to make up. And even their shift to, Mercedes and all of the big cars actually stopped selling their cheapest models because they want to focus on margins, and it makes sense. But you still need the volumes. Even Porsche, you can't compare Porsche to Ferrari. I mean, if you look at their stock prices, Ferrari is, I think, at an all-time high, or at least very close, and Porsche is not. And they're both very expensive, but Porsche is still, you don't have to be extremely rich to afford a Porsche, right? So that's, I think, in the only European place that are protected against China are companies like Ferrari or Lamborghini. These, let's just say, it's like Rolex. Rolex is not competing with an Apple Watch. It just, for Europeans, for most of these companies, it's still about volumes, and that's a big problem.
Yeah, I'm kind of sad to hear that. My first car out of school, the first legitimate non-used car that I had was a Volkswagen Fox. It was like a 1992 Volkswagen Fox, which is a Polo, I think they called it in Europe. It was you could hose it out, like it was everything was vinyl and it was steel, and I think it was manufactured in Brazil. But
the Fox, I think that's a South American,
yeah. And so that was kind of the cheapest of the cheap cars that you could get back, when I was coming out of school, and now it's Chinese cars. I just wonder, like, Bob, what do you think? Do you think Americans in 2025 are going to say, hey, I want a Chinese car? Do you think that's something that's right around the corner?
Well, I grew up in Detroit in the late 80s and 90s, and you know, the tale I always like to tell is that we were you know, most people learn Spanish or French or things like that. We learned Japanese so that
Yep.
the incoming Japanese auto executives that were eating our lunch, we could speak with them as frontline employees. And so you know, I think that experience certainly colors what I'd say how I think these sorts of things are likely to play out, which is, you know, if a producer can produce a much more competitive product than what's being domestically produced or being produced by other producers, then they're going to win and they're going to figure out a way to win. And, you know, in 1980, I think people really shuddered at the thought of Japanese cars, you know, taking things over. And by 2000, you know, the U.S. automakers had fallen behind, and you know, Toyota was the largest automaker in the world. So,
Right.
you know, what's going to happen? Like the Chinese automakers are going to be the largest automakers in the world, and they're going to produce very reasonably priced cars, and it's going to be highly competitive. The real question is that are those cars ever going to see our shores? If they do see our shores, then people will be more than happy to buy the cheaper car. You know, there's no question about that. We'll fly on Brazilian airplanes because they're cheap, and we'll drive Chinese cars. No big deal. The question is basically, do you have a administration in place that's going to let that happen? If they don't let it happen, it's just inflationary. That's all there is to it. And
Sure.
it's simply creating a tax in one form or another on the middle class of America who would otherwise be able to consume those cheaper cars or, you know, buy those cheaper cars. But, you know, people will quickly forget their loyalty to the Japanese cars or the Korean cars that they've been loyal to, so to speak, and quickly shift to Chinese cars. What's it matter, right? Like, you
Sure.
know, there's no difference. If it's a foreign brand, it's a foreign brand. What's it matter if it's Japanese, Korean, or Chinese? It
Sure.
just
I think
matters what the
that's
price
fair.
is.
I think that's fair. And I think what's happening in Europe is bound to happen here at some point. I think part of it is just a matter of um, trade policies and consumer preferences. And I think part of
I
it
would
is
also say, Tony, I would also you need, especially in Europe in the US, a dealer network, and that takes time. You know, you need your car service, and you need a showroom. And in the big cities, that's not that big of an issue. But to really reach the masses, I think that takes many years, and especially in the US. And obviously, Bob is right. When they reach the shore and that's cheaper, they will gain market share. But I think it will take many years. And with Trump coming, I mean, if he wins, that will probably be delayed another 4 years, this process, at least. But I think, yeah, there is a point, but they still need this dealer network. And that even, for example, in the tractor markets, when you see, I mean, Germans want to penetrate in the US, and it's still, I mean, Echo, this American company, they bought German Fendt, and it's a premium tractor brand that competes with John Deere. And it has been a premium tractor brand for decades, but they still have a very hard time competing with John Deere because John Deere has the dealer network and they cannot compete with it. It takes them so long to build it. So that's one of these. I mean, their technology is really good, but it takes them so long to build this network to compete with John Deere. And I think the same is bound to happen in the car industry, also in Europe, but it will be much faster process in Europe because there is way more support from the consumer. But in the US, it will probably take a very, very long time until Chinese cars go
it'll take a
mainstream.
while. But what's interesting is in previous companies, I had excavator companies as clients. And when I drive by construction sites in the US, almost every construction site has a Sany excavator on its site. It's SANY. It's a Chinese excavator company, extremely successful. And somehow they've penetrated the US market, whereas 10 years ago, those would have been Korean excavators. And now they're Chinese excavators. So, you know, I don't know how much of the US market they hold, but based on just my observation, it's not small. And so there are ways where Chinese companies can get heavy equipment and vehicles into the US and penetrate that market. And I think Sany is probably a company that Chinese automakers should study if they want to do it successfully. One last thing on this, specifically on automobiles, is Elon Musk, I think it was last year, the year before, he was giving a speech and he said the Chinese electric vehicle markets, those firms have the highest spec electric vehicles of anyone on earth. And I took notice of that because he's talking about his competition. And so, it's not the Germans, it's not the Koreans, it's not the Japanese. He specifically called out the Chinese and said that they're the competition. It's really nobody else. And so I think, Europe is already seeing it. I think the US really needs to prepare for that because these aren't just cheap replaceable cars. Even Elon Musk said that they're high quality cars. So, okay. In terms of hollowing out, Leo, what other industries, what are obvious industries in Europe where there's a huge amount of Chinese influence?
I would say it's consumer goods and electronics. I mean, if you look at Shein, I don't know if I pronounce this correctly, but these in Temu, these, and that's a problem in the US as well. China really found a way to dump really cheap consumer goods in Europe and the US, and they even managed to do it without having the same distribution network that Amazon has, for example, and that's scary. I mean, they even compete with, I don't know, what's this cheap I forgot the name, but these really cheap clothing retailers that we have over here. Primark, yeah, that's the one. Yeah. They're even way cheaper than Primark. So it's and people love it, and they pay influencers to do these shows and promote their products. And it's Chinese companies, and even, I mean, the EVs are great, but the consumer products that they dump are trash. And they have figured out how to do the marketing. And the internet, I don't have TikTok, but I know what's going on TikTok. And they do aggressive promotion, even from small toys and stuff that can do that can they did this polish on your shoe where you can spill ketchup on it and it just washes off, and it's all fake. None of this works, but they ship I don't know how much to Europe, and that's one big problem, because some of these it sells so well because of inflation and structural issues. People just don't have the money for these goods. So obviously when you go on Shein and you can buy a dress for, I don't know, $5 to $10 or whatever, you buy it. And even electronics. So what if your house burns down? It's still cheap, right? So it's that's one of the biggest issues. But on a more serious
note, not sure about so what.
I mean, some people still don't care. And even 5 and 10 years ago, they warned people, don't buy cheap iPhone chargers on these websites, and they had different names back then, because if quite a few houses burned down because of these cheap chargers, and it's still happening. So consumer is one big problem, but I think in general, because of these energy, that what Tracy talks about, these energy issues that we have in Europe, it's also way more attractive to produce chemicals in China and steel and basically every component you need for renewable energy. So even by shifting to renewable energy, we become less dependent on Russia, but way more dependent on China. And even what worries me a lot, and I tweeted about this a few times, when I stopped tweeting about it because it's just what's the point? But it's when Germany loses the chemical supply chain, and to me that's way more important than automotive industry. And I did my internship at Henkel, which was right in the middle of the chemical hotspot. It's so important to do this because chemicals are used in every single supply chain, and they're also one of the best leading indicators because they are used in every industry. And when companies like BASF move to China, I mean, that's very worrying, because bringing back these industries takes time. It's not like when the next administration says, we bring back nuclear energy, that all these companies say, okay, now what, we are going back next year. That's a big deal. And when you look for a country to produce, whatever, you want companies that supply the chemicals, especially after the pandemic. You need a reliable supply chain. And consumer products is one thing, but when chemicals are leaving, that's something that really worries me. That trend is also, I think, still going unnoticed, but it's getting worse.
And these are capital intensive sectors that are
Oh, yes,
decades to get
absolutely.
back, right?
Yes.
So, okay, guys, we've gone a
Billions.
long time. My light has turned off. We've gone so long. So I appreciate the time you've taken to this. Let me ask one question to both of you guys. Do you see a EU-China trade war coming? Is that kind of on the cards, or do you think EU is going to kind of comply with what China wants in the interest of larger relationship and all that stuff?
Well, if I would say from my personal point of view, I think it's not going to be the kind of trade war that the US is going to risk with China, because our companies still rely on China, and none of them benefit from a trade war. And I mean, that's a funny thing. If Germany were to make a case for higher tariffs on Chinese cars, then China would put tariffs on a lot of French products, and that's not in the interest of France. So it could happen, but from my personal point of view, the risk of a full-blown trade war that's going to crush margins is low. But we never know.
Bob, what do you think?
Yeah, I mean, I think the openness, the European openness to integration with China has been just a lot higher if you just look over the course of the last 10 or 20 years. And I don't see a lot of underlying evidence that would suggest that path has changed. And so my guess is that the Germans will be driving around Chinese cars pretty soon. And they'll like it a lot. Whereas, obviously in the US, there's a pretty different view on China that makes it pretty inconsistent, that it's going to be challenging. I mean, a trade war with China already exists in the US.
It does, yeah. It has for
the question
6-7 years.
Right. The question is basically, is it going to be even worse than what it's been, or is it going to be basically the same, right? Because since it has been the same across administrations, and so seems less likely to resolve itself in the U.S. context.
That is correct. So, guys, thank you so much. Thank you so much for your time. Thanks to Tracy. I really appreciate this. Have a great weekend. Have a great week ahead, and we'll speak again soon. Thank you.
Well, thank you for
thanks so
having
much.
me on.